We begin here in Nigeria to discuss the lifeblood of finance, which is interest rates. It's a new report from the CFG Advisory, co-authored by the chairman of the Bank Directors Association of Nigeria and the CEO of the CFG Advisory, titled Adverse Effects of High Interest Rates Spreads on the Nigerian Economy. Just to remind people of how we got here, the benchmark interest rate, the last decision that was made by the Monetary Policy Committee, did raise the benchmark rate to 27.5%. The asymmetric corridor was unchanged. A cash reserve ratio at 50% for deposit money banks. That wasn't changed either. 16% for merchant banks. Liquidity ratio at 30%. Now, as we move on from there, there's a chart that we like putting up for our viewers. This is looking at the spread between the monetary policy rate, that's the benchmark rate, and where inflation is. 34.8% year on year was headline for December, and we're at 27.5. So that's the blue line for your year on year inflation, and the what is that, burgundy orangish line is the monetary policy rate. So that's just to pick everyone up to speed. Let's introduce our guests as we get into this report. We have, of course, very happy to have Mr. Mustafa Chikeobi, who, of course, is the chairman of the Bank Directors Association of Nigeria, and Mr. Tilewa Adebajo, CEO of the CFG Advisory. Gentlemen, good morning to you both. Thank you so much for joining us. So I guess just to help the non-finance oriented folks that are watching, can we just define an interest rate spread for our viewers?
Okay, before I go into that,
yes,
I want to say this report that was written by Tilewa and I is not an attempt to solve all the economic problems of Nigeria. We're not trying to solve inflation in Nigeria. What we're trying to do is to point out that there's a significant drag on economic growth. People who are smarter than us will do studies about it, but we guess it's about 20 to 30% drag on GDP. Because we have what you now want me to define, the interest rate spread, which is the difference between where banks, what they pay for deposits, and the difference between that and what they lend to the prime customers.
Okay.
Currently in Nigeria, that spread is at a historical high. And we believe that the impact of that spread being at a historical high will be a significant drag on GDP, no matter what else we do. Even if we increase oil production by 500,000 barrels a day, this is a bigger drag on GDP than that. And so people focus on oil production and other things, but people are not looking. We're trying to sound the alarm that this is a huge problem for the economy. And I'm sure we'll go into the reasons why it's a huge drag. So the interest rate spread, simply defined, is different between where banks pay for deposits and what banks lend to the top customers. And it's at a historical high right now.
Mr. Taylor, I want to bring you in here. There's a chart from the report. It has, I think, bar charts. You've got Nigeria in blue, the interest rate spreads in Nigeria, there it is, compared to African peers in green, and then the G20 nations in yellow. So, illustration here. What's the takeaway?
Well, the two takeaways we've gotten from this is that we've looked at the research from about 2009 to date. And I think, as Mustafa mentioned, the interest rate spreads now at an historical high of 16%. So if you take a look at this consistently over the years, Nigeria has had the highest interest rate spreads in the world. And the reason for this is that we have some very systemic challenges, as you can see now with inflation. And so that is why we need to be able to push our rates up high in an effort to drive inflation. But again, this is not an inflation discussion.
Right.
But what we're seeing is the fact that if you take a look at from 2009 to date, consistently, Nigerian interest rate spreads have been high. And later on in the program, we can take a look at its impact on GDP,
right,
which Mustafa mentioned earlier, and that drag. So we've done that research, and I think we'll also share that results of the exact impact on GDP.
Now, I did want to, well, I guess we can get into the causes now. We extracted this from the report. Perhaps we can, talk through them. Which of these causes is most, prominent as far as the causes here? So we've got regulatory requirements, we've got the monetary policy stance, we've got liquidity and funding, high credit risk. Which of these jump out? Is it all of the above? What are your thoughts on as far as the causes of this rate spread?
Well, I'm glad you asked the question. The biggest impact on that interest rate spread is regulatory, and it is the CRR. Nigeria has the highest CRR, cash reserve ratio, in the world at 50%. The next to Nigeria is Turkey, and you know Turkey had serious financial issues at 25. You have places like Malaysia and Indonesia at 2%, China at 9%, we're at 50. What this simply means is that for every Naira deposit a bank gets, they must give half of it to CBN, 50%, at 0% interest rate. So what we do is that if we're going to take a deposit that we should pay 20% for, we pay 10% because we're giving 10, we're giving half of it to CBN. That's the biggest impact on the spread, on the interest rate spread, by far. You and I understand that if CBN says CRR is 100%, that's the end of banking.
Right.
We will not take deposits and will not make loans. And at zero, we will lend more and interest rate. In fact, in many countries, the lending rate is lower than the monetary policy rate because they have money to lend to selected industries. So I actually believe it's lower in many cases in the US, where the lending rate is to IBM will be lower than the monetary policy rate. So that's the biggest impact. Now the others, charges. You say Nigeria is the only country in the world with an AMCON levy that has continued for over 15 years. The AMCON levy is now the second biggest item on banks' expenses, apart from salaries. It's now AMCON levy. That has to be addressed because that's a charge. And the way banks respond to that charge is by lowering their deposit rates and increasing their lending rates. Now they've mentioned windfall tax, which sounds good on its own.
Yeah.
But the windfall tax will show up in that spread because, again, banks will react to it by lowering their deposit rate and increase. So all these charges that individual electronic money transfer levy, people think, oh, let's take money from the banks. But the banks pass it on to their customers in the form of this spread. And that's what drags the economy down. Companies cannot borrow, there's no access to credit, and people cannot save because we're giving them very low rates for saving. Those are the causes. And so they have to be coordinated. I'm not saying they shouldn't do a windfall tax. We're not saying they should not raise interest rates. We're not telling them what to do. We're just saying every action that you take has an impact on this spread. And this spread has an impact on your economy as a whole. So let's think about it before we do it.
Do you want to share your thoughts on these causes as well?
Well, yes, I think it's very important to expand on what he said, because one of the things you should also understand is that even if the rates were like 20%, if the spreads are high, it's also not to an advantage. So it's not just about high interest rates. It's really about managing the spreads, because we can have interest at about 20%, but the spreads are still higher. So it's important to understand what is driving those rates. But again, the only thing I just want to add to that is the fact that we have an extreme situation whereby we're trying to manage inflation. You've mentioned the Fed, for instance. Now, you've seen a coordinated policy with the Federal Reserve Bank in the States where interest rates hit 9%, and it took them 2 years of increasing rates to be able to manage inflation, bring it down to a level where they can finally cut the rates. So you see, this systematic approach is really what is missing in Nigeria. And because you don't have that systematic approach, you have a lot of structural deficiencies within the system that causes these distortions and ultimately impacts the interest rate spreads. So it's important for us to have an orthodox approach to be able to manage not only our fiscal policy, which invariably impacts that. And you understand that the fact that we have cumulative deficits over the last 3 years now is now 36 trillion. And you have a 13 trillion deficit to fund this year. And you also have a situation whereby 16.3 trillion, which is about 40% of the budget, is going towards debt service. So we need to be able to have a balance in terms of how we manage the economy to be able to have a stable environment.
What would be your reactions if one was to say, well, the AMCON levy is needed for bailouts to cover busts for corporations, or CRRs to curb money supply, growth of money supply? What would be your reaction to?
Let me react individually. That's what I think we're trying to sound an alarm.
Right.
Those things may make sense individually. It may make sense to charge banks a windfall tax. We're not contesting that. It may make sense to have a high CRR individually. But when you add them all up together, when each silo is doing what makes sense in that silo, when you put it all together, the impact is that, and let me tell you what the impact is. Banks are not lending to construction, they're not lending to industry, they're not lending to manufacturing, they're not lending to SMEs. The only people that can get a loan from a bank today are people who have a life cycle of 6 months or less. So petroleum importers, import-export people, not people who are making things. So 2 years from now, our import dependency will actually be increasing because we're no longer making things because we can't afford to make it. The highest cost today in business is financing costs. So you look at businesses today, they are not viable with this interest rate and this interest rate spread. And I'm saying 2 years from now, we'll feel it. We will see the fact that nobody has borrowed money, nobody has grown, we're importing everything, and our import bill is growing. And that's because we're not coordinating all those things. So if FRS wants to do windfall tax, they should sit down with CBN and Ministry of Finance, and there should be somebody looking at saying there's too much taxes on banks already. Nigerian banks are the most taxed institutions in the world. We've looked at it. So you say AMCON levy, NDIC fee, there's the EMTL levy, there's the windfall tax that's coming, there's the CRR. All of those things together may make sense individually to fight inflation, to fight fiscal deficits, to fight debt, but together they don't make sense. That's the point we're making. This is another response I always get. Banks make a lot of money. Well, what's for the average person that says when they see results being declared, billions of profits and so on and so on, what would be your response to anyone that says, please, I know you want to take that. Let me take this.
Yes, yeah.
First of all, banks are the only institutions that have the unlimited ability to pass costs on to their customers. So if you can tax banks more, all they will do is they will widen the spread,
right,
and they will make the same amount of money. It's not necessarily a bad thing for banks to make money,
right,
because the money that banks make go back into lending into the economy. It has a higher multiplier than giving the money to government. Government multiplier, as you know, is lower than private sector multiplier. Right. So the fact that the bank is making money is not necessarily a bad thing for the economy. What is bad for the economy is if banks are stopping their clients from making money, because that affects the economy. All we're talking about is GDP. My estimate, and smarter people than me will do this estimate, I think our GDP could be 30% bigger if that spread was below 5%.
Gotcha.
I think it's important that we address it in a collective manner. Please, you can answer it. Go ahead.
Well, I think what is important for me is that, you see, the banks have, because of the way the economy is, they're attracting an undue attention to themselves because you're doing better than the rest of the economy, and there must be a reason why. And that's the question that you need to ask yourself, because the distortions in this economy is what is reflecting in the banking system. And the question is, how do we correct or normalize these distortions? And I think that is what is important. Because if you take a look at one of the charts, I don't know if they can bring it up in terms of looking at the relationship between the interest rate spread and the GDP growth.
Yes, we have that chart. Let's put it up. Yeah. There it is.
Yes,
yeah.
See, what we found out is very simple. The lower the interest rate spreads, there's an inverse correlation between interest rate spreads and GDP growth.
And just a moment, just for our viewers, the GDP annual growth is in gray and the interest rate spread is in blue. So please go ahead.
So what we found out for the last 15 years is the fact that when we have a lower interest rate spread, we actually have a higher GDP growth.
Right.
So there's that correlation. So it's beneficial for everybody. But you see, when you have the distortion, so when you have the high interest rate spreads, you will see that the annual GDP growth rates are lower. So it is beneficial that the interest rate spreads are lower. And that's what we're talking about, in the sense that that is the impact that we've seen. So what is important is that when you have the high interest rates, if the spreads are higher, then there might be low GDP growth rate,
right,
but the banks, because of the high GDP, the high spreads, are making more money.
Right.
So those are the distortions that you cause in the economy to do that. So what we're saying is that eventually we need to stabilize that. So, and again, what I'm trying to say is the coordination. You see, which when Mustafa talked about silos, the whole essence is economic management and coordination at the highest level. How do you manage your fiscal policy to impact on monetary policy? Because if you don't get your fiscal policy right and you have those distortions, monetary policy will react with high interest rates because of inflation, which is where we find ourselves with the CRR. We have an extreme situation, and that's why we have an extreme CRR position. So we need to manage our economy back into what we call equilibrium. And when we're at equilibrium, then it's fair for all. The interest rate spreads are lower, the banks are not making as much money, or even if they are, everybody else is making much more money, so they're not looking at the banks. Everything is stable, and it's a win-win. Because if you take a look at the high interest rates, the manufacturers are complaining, but the pension funds, the pensioners and the investors are not complaining because they're making a bumper harvest in terms of their investment returns. So there's a flip-flop now. You see, so the scale is not balanced, so it's tipped to one side. So what we're looking to do with monetary policy and economic policy coordination is to go back to that balance so that you have a rate whereby everything works out for both the investors, the bankers, the manufacturers, because these are the situations that we have. So this is the results of what we've seen, because there's a direct correlation. And clearly now, with this sort of spread rates, you're going to impact growth.
In fact, it'd be perfect, because let's put that chart back up. They just put it up there from the report as you were speaking. So the impact, reduced investment, limited access to credit, higher costs of borrowing, slower economic growth, inequality, poverty, low savings rate. How complex is this task to be able to get this equilibrium that you both are talking about, to have everyone come to the table and sort this out? Because it seems like is it a really hard problem? Can it be solved in the time frame and so on, as we look at this impact from the report here from these spreads?
Yes, I think it can be solved.
Yeah.
Again, as I said at the beginning, we're not criticizing any policy.
Right.
No, I would recommend any policy direction. Okay, what we're just saying is that here's a problem. You guys that are running this economy, sit down and coordinate it. The things that are necessary, we do them. The things that are not so necessary, we don't do them. And to talk about, again, this issue of banks making money.
Yeah.
Telecoms are just as important in our economy as banking today, maybe close. But they can't get the tariff they want. They have to go to NCC to get a tariff increase, and you know what that takes.
Right.
Banks don't have to do that. All banks will do is reduce their deposit rates and increase their lending rates. That's how they respond to those things. So again, the individual initiatives may make sense, but let us have a way. When CBN wants to do a CRR, there's somebody they go to who says, this will impact this and it will impact this. Instead of doing 10%, do 5%.
Right.
We should have that kind of coordination. And theoretically, the Minister of Finance and the Korean Minister of Finance should be doing that. But he has a fiscal bias by virtue of his role. So it's difficult for the CBN to trust that his views are not biased towards the fiscal. So there should be some coordination. And we're sounding the alarm. This will not show up now. But 2 years from now, we will be making nothing. I don't know any manufacturer that can afford to continue to manufacture at 38% interest rate.
Right.
It's not possible. So we'll be making nothing and we'll be importing everything. And that will again put pressure on FX 2 years from now. So let's discuss this problem and let's let the smart guys in government find a way to solve it. So we're not criticizing, we're not recommending, we're just saying, here's a problem we've identified. There's a cancer in our economy.
Yeah. There are suggestions in the report as far as what to do to narrow the spreads. Let's see. So you've talked about lowering the cash reserve requirements, talked about monetary policy reforms, and then fiscal policy reforms. Tilewa, is there enough time to get this done? I mean, 2027 is not far. Electioneering might begin 2026. Does this go beyond one term for an administration to put this together, these solutions or suggestions on the screen?
Yeah, it's a one-year program.
Yeah.
And like I've told you, I always go back to, you see, let's understand that there was a time in this country when inflation was at 10%, 9%, 11%. And, economy was growing at 8 to 10%, 12%, 13%. It's not magic. You need to look at the levers. The key problem is the government expenditure. It's excessive. So we need, and like we've said earlier, there are lots of people doing well in silos, but that's not important. We need an overall coordination to be able to look at the big picture as to see how we can focus the economy. So we need like the overall coordination and management of the economy so that we can now begin to see what the bigger impact is. So you might be working very hard in your silo, but people should be able to channel that effort into something that is going to bring out results. And if you do that, if you sort everything out, then it shouldn't be a problem. We've sorted out the issue of the petrol pricing. Foreign exchange has stabilized. So I don't really see any cost push effects now on inflation as we see it. Yeah. So basically with the sort of stability we've achieved with inflation, then I don't see any reason why the trajectory on inflation cannot come down. But we need to manage this in a proper manner and in a coordinated manner. If we do that, we can achieve results in a year. Because it's about confidence. Yeah. Once investors and the markets see there's confidence in what you're doing, they'll respond.
So do you agree with the 1 year time frame, or do you think there's enough in a relatively 12 months like this can be achieved as well?
I think CBN can reduce CRR tomorrow, if they wanted to. We recommend it, and just for record, this was done under Emefiele, right, where some portion of the CRR was given back to the banks to lend to some critical industries. However, that was done at the discretion of the CBN governor, and it led to abuses. It can be done systematically. CBN can say, for these industries, you can get back some of your CRR and tell everybody what the policy is. It's not discretionary. If you are borrowing for manufacturing, you can borrow at 20% from CRR at an interest rate not exceeding 20% at a tenure not less than 5 years. Then banks can make that decision, and that will bring down the borrowing cost. Emefiele did try it, so it's not a new suggestion. The other things, I think all this costs should be rationalized. AMCON cost, NDIC levy, AMCON cost and NDIC levy are duplication. NDIC does not spend its money on rescuing banks. All the banks that have been rescued recently have been rescued either by CBN or by AMCON. And so what is the NDIC levy doing? That's something, maybe NDIC levy should be suspended until AMCON is done. There are things that we can discuss that are constructive to the economy that can change this in the next 6 months. The longer fiscal issues will take time, but I think 1 year is plenty of time to coordinate the economy better.
Got just about a minute or two left, so we're rounding up. It's January, so I guess putting this into perspective, what are your respective outlooks for the Nigerian economy for this 2025?
Well, for me, I think what I've said is that I think we need to maintain the orthodoxy from the stability the central bank is providing. It's very important. The reason CRR and all these rates are where they are is because of the situation in the economy. Monetary policy will always respond to what the situation is in the economy. And like I've said, and I think we've continued to say, I believe that the foreign exchange regime can be sub 1,000 or can be north of 2,000, depending on how the government implements its policies and the sort of economic policies they roll out. Because we're not talking about reforms anymore. We're now talking about implementing significant growth policies that will drive economic growth and create an employment for Nigerians, and we should be able to restore our output gap. Yeah. One of the key problems in Nigeria is that we have an output gap. Our productivity is low, and we're not producing at the levels that we're supposed to produce. And if you can see, that has impacted our GDP, which is now 200 billion. So even if you're going to rebase, which is what I've told them, if you try to rebase the economy on inflation, that's why they're using 2024 as a base year, you'll find that the inflation rates could probably hit 40%. So we need to be very careful with this rebasing. Because if you take a look at our GDP growth, in dollar terms, it's negative.
Gotcha. Mr. Achiko, your outlook?
I'm not as optimistic as he is.
You're not. You're as optimistic.
I'm not.
You are not as optimistic. Can you quickly, in 30 seconds, quickly share why, in 30 seconds, why your outlook is not as optimistic?
I have not seen anything that has changed. We have a foreign exchange demand in Nigeria that's 30 billion a year. So my question is, how are we going to find the 30 billion a year?
Yeah.
We keep borrowing euro bonds and adding it to our reserves that we have to pay back. We must think of how are we going to create dollars.
Right.
And if we cannot create dollars, how are we going to create goods and services here that we don't have to pay dollars for?
Yeah.
I have not seen that, so I'm not as optimistic as he is.
Mr. Musa Chike will be the chair of the Bank Directors Association of Nigeria. I appreciate your honesty and candidness. Same with Mr. Tilewa Adebajo, CEO of the CFG Advisory. Thank you so much for this report. I encourage everyone out there to read it, and we appreciate your time. Thank you both.
Thank you.